All right, let's get right into it. Today, we're digging into a classic Wall Street head-scratcher, State Street's latest earnings report. The main numbers looked pretty solid, but the market's reaction, not so much. Let's figure out what's really going on.
Okay, so here's the puzzle we're going to solve. On the surface, State Street had what looks like a great quarter. They beat what the analysts expected for revenue, and they beat on the earnings number they really want you to look at. But the stock just tanked. What did investors see that made them hit the sell button?
And this is what that reaction looked like. On January 16th, the day all of this news dropped, the stock fell over 6%. Now that's a pretty big move, and it's a huge clue that the market was looking way past the good news on the surface. Something else was going on.
And here's the thing, the top-line number, the revenue, it looked really strong. It came in at almost $3.7 billion. That easily beat what analysts were forecasting, and it was up a healthy 7.5% from the year before. So far, so good, right?
The good news kept on coming with the number management really wanted to talk about, their adjusted earnings per share. At $2.97, it was a solid beat, almost 5% better than expected. And you better believe that on the earnings call, this was the number they kept highlighting.
But here's the number that crashed the party. The official, by-the-book, GAAP earnings per share. It was only $2.42, and that wasn't a beat. That was a huge 13% miss. And this is the disconnect that completely spooked Wall Street.
So, you see what's happening? State Street's earnings day gave us two completely different stories. And to understand why the stock dropped, you have to get into the massive gap between the official reality and the story management was trying to tell. And this lays it out perfectly. On one side, you've got the official accounting number, a big, ugly miss, and on the other, you've got this adjusted number, which paints a much happier picture. The entire market reaction really comes down to which one of these stories you think matters more. So how in the world do you get from that big mess to a nice beat? Well, the answer is this little bit of financial jargon called notable items. These are basically expenses that a company says, hey, these are just one-time things. They don't reflect our real performance. This quarter for State Street, those notable items added up to a massive hole of over $200 million.
So let's follow the money. Where did it all go? Well, $111 million for something called workforce repositioning. Let's be real, that's layoffs. Another $69 million for real estate optimization, which means they're shrinking their office space. And then $24 million for other changes. These are the costs that just blew a hole in that official GAAP earnings number.
Now, on the earnings call, management spent almost no time talking about these charges. Instead, they pivoted, and they pivoted hard to their grand vision for the future. They tried to frame all these costs as necessary investments to build a better, more modern company. And here's that vision, straight from the CEO himself. He wants State Street to be the essential link, the bridge between the old world of finance and this new world of digital assets. It's a really ambitious goal, and it's designed to make investors think, okay, maybe this short-term pain is worth it.
The whole strategy really boils down to three big things. First, use AI to find $500 million in savings every year. Second, launch a brand new platform for digital assets and tokenization. And third, push deeper into servicing private markets, which is a really fast-growing space. It's a pretty compelling story.
But the analysts on the call weren't totally buying it. The Q&A part of the call made it pretty clear the market was skeptical. Management's guidance for 2026 sounded kind of cautious, and analysts just kept hammering them on expenses. Could they really control costs while making all these huge new investments? There was a lot of concern about whether this growth story could actually hold up.
So that brings us to the final part of our breakdown, the next call. This is where we cut through all the noise and tell you what we think is going to happen next. We're kicking things off with a market perform rating. The way we see it, State Street is stuck between a rock and a hard place. They have a solid core business, but they're trying to pull off this expensive and pretty uncertain transformation. The potential upside from their new strategy is basically canceled out by some very real risks.
And here's our forecast for the first quarter of 2026. We think revenue growth will be okay, modest. Their core business is still chugging along. But the real story, the one thing everyone is going to be watching, is expense discipline. Can they control costs? Until management proves they can do that while still investing for the future, we think the stock is just going to be range-bound, pretty much trading sideways.
And that leaves us with the billion-dollar question for investors. Management has this bold vision for a high-tech State Street, but the market has made it crystal clear that right now it only cares about costs. So the race is on.
Can the payoff from this big digital pivot get here before Wall Street's patience runs out completely?
And one last thing before we go. This analysis was for informational purposes only. This is not financial advice.